New IRS budget impact on self-directed IRAs. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. On today's podcast, going to dive into the 150 plus page IRS report on its budget and what impact it could have on self-directed IRAs, 401ks, and other potential taxpayers. So this report came 30 days later than actually requested by Treasury Secretary Yellen. So IRS not off to the best start, 30 days late in this report, but it's a monster report. And it talks about how they're going to spend their $80 billion of cash that they got in because of the Inflation Reduction Act, which was passed by Congress in August 2022, signed by the president. And had a lot of controversy. I've done a bunch of videos and podcasts on the IRS spending $80 billion, but now we got more details in terms of exactly how they're going to spend the money. Well, not exactly. They're not going to tell us, but they gave us categories of taxpayers that they're going to start looking at more closely. Now, the best news of this is that the word retirement is not mentioned once in this report. So IRAs, 401ks are not a target for this new funding. Maybe it will be caught up in the crossfire of just having more agents, but probably not, just because IRAs, 401ks are not big revenue generators. 99% of all IRA, 401k investors are not doing private transactions. They're investing in stocks and real estate and fixed income. They're holding the assets for investment. They're not looking to personally benefit from that investment. So it's very, very small segment of folks that are not doing what they should. And the IRS knows that. And that's why they're just not focusing on retirement accounts. Now, this report confirms that because they didn't even mention IRAs other than the name of the bill, the Inflation Reduction Act. Self-directed IRAs, 401ks, solo Ks were not mentioned once. So just let me set the table kind of where we stand. In 2010, the IRS operated at 95,370 full-time employees. And that was intended to meet the demands of about 310 million Americans. Today, the IRS is almost 20% smaller. It's about 80,000 full-time employees, and they're serving 334 million folks. Okay, a 7% increase. So essentially, that's why the Inflation Reduction Act proposed giving the IRS $80 billion to go out and become a more modern, lean fighting machine. Well, maybe not lean, but a mean fighting machine for sure. And we'll talk about where some of that money is going. But essentially, the strategic operating plan outlines how they're going to spend their money. Okay, and the Democrats obviously supported this, including new commissioner, IRS Commissioner Danny Werfel. I said, quote, "The agency's transformation will help bring in an estimated $500 billion the government misses out every year due to tax evasion, all the while making it much easier for Americans to file their taxes every year." Obviously, Republicans have a different point of view, and they feel that this expansion is going to unleash an army of auditors against average Americans and small businesses. Well, in order to essentially combat what the Republicans are saying, President Biden has made it clear, and so does this report, that taxpayers that earn less than $400,000 will not see an increase in target. And I'll discuss why that's going to be difficult to hold true to. Let's see with some other information. In 2021, the IRS counted almost 78,700 employees, and they're looking to bring in another 20,000 new employees by the end of 2024. It will include 7,239 hires in enforcement, 6,500 or so in taxpayer services. So most of the people, the new hires, are going to be in enforcement. Okay, and they don't provide essential information in terms of how many employees the agency would like to hire long term, how exactly the IRS will comply with the pledge not to target taxpayers that make them 400,000 plus. But again, it did present a very, very lengthy document that kind of goes through their idea. So the four categories of targets is enforcement, technology, client services, and those are really the main categories. Um, but I'm going to focus on enforcement because that's what we all care about at this point. The technology, making it easier for taxpayers to file, client servicing, that's all great. That's good. But we care about enforcement, right? We want to know, is there going to be an army of IRS officers banging down our doors to come after us for deficiencies? Well, the Congressional Budget Office estimates that an additional $80 billion provided to the IRS will increase federal revenues by more than $180 billion. Okay, so the IRS says trillions. The Congressional Budget Office estimates at about 180 billion. So the idea is that, hey, some of this money, about 50% will be spent on enforcement, and most of the employees hired will be towards enforcement. Why? Because it's going to bring in the most money. Makes sense, right? You get if you look at anyone's tax return, whether it's Donald Trump's, whether it's Adam Bergman, whether it's John Doe, you're always going to find something. There's probably any businessman, business person, company, small business, large partnership, large corp. There's always going to be, a gray area, whether it's a deduction, whether it's an expense, something that, evaluation of a loan, or how someone treated a payment, where the IRS can come in. For example, you use your company's frequent flyer miles for personal use. Like, you can always get something if you really want to. So the idea is that it's not something that, shocking to say that, yeah, give us more people, more money, we're going to bring in more revenue. No kidding. You're going to scare people to comply. You're going to scare people to settle because it's just not worth fighting with the IRS for certain issues. And that's, the fear a lot of Republicans and taxpayer advocates have had, is that, hey, if you look at anyone's return, you're going to find a problem, and you're going to scare people into paying when some of these folks just can't defend themselves. So let's talk about who they're going after. Okay, now just to be clear, there's a directive. Small businesses and households earning $400,000 or less will not see audit rates increase relative to historical levels. Okay, that's straight up from the report that's from the IRS. So let's talk about large taxpayers first. And this is where we stand now. To constrain resources, large corporate enforcement activities have decreased in recent years, with the audit rate falling from 10.5% in 2011 to 1.7% in 2019. Large corps have complicated voluminous tax filings that involve a variety of tax issues, such as cross-border activities, financial product issues, transfer pricing transactions. These are super complicated. For example, Section 482 transfer pricing. The first law firm I worked at, I had a colleague that worked on a transfer pricing case for 3 years, okay, involving a major Fortune 500 company. These things are super, super complex and take years to unwind. So clearly, there's a lot of money at stake. The IRS feels that if they put more attention there, they'll scare more businesses into compliance and to paying, and they can generate a larger reward. So that's the first area, is large corps. The issue is it costs money to train, well, time and money, right? You got to find people that understand large corporate tax returns, large corporate issues, whether it's cross-border, international tax, transfer pricing, depreciation, royalty payments, whatever it is. These are complex areas. You can't just hire someone off the street and train them in 6 weeks, and they're going to be able to audit large corporate tax returns. Some of these folks are going to have to be attorneys or accountants and trained for many, many years. So I know they plan on hiring these folks in the next year. I don't feel like we're going to see an increase in compliance in these areas for many, many years. So that's the first, large corp. Large partnerships. The IRS has not had the resources in recent years to sufficiently address the significant growth of partnerships. For example, the number of partnerships increased by 32% in just a decade, from 3.2 million in 2010 to 4.3 million in 2020. Partnerships with assets exceeding 5 million were even more, by 75%. Many of these partnerships are complex, many tiers, and sometimes thousands or even hundreds of thousands of partners entities, each with which can be legally recognized entities such as an individual, a corp, foreign entity, or another partnership. Because of their size and complex structure, Partnerships require specialized capabilities and often significant resources to audit. In 2019, the audit rate for partnerships was 0.05%, so a half of 1%. So again, their goal is to increase in this area, just like large corps. Why? The idea is if you have partnerships with more than $5 million of income, there's a greater chance to get a greater tax reward if you audit these versus a partnership with $20,000. Now, how do you confirm that? Let's say you have a partnership that has $300,000 of income, okay, and you have a pledge that you're not going to increase audit rates of taxpayers under $400,000. Now, how do you know that that partnership that has reported $300,000 didn't take an incorrect deduction that reduced its taxable income from $2 million to $300,000, or from $600,000 to $300,000? So it's awfully hard, and that's the problem. A lot of taxpayer advocacies have said it's like you say you have this 400,000 arbitrary number. Like, what's 400,000? Are you saying everyone above 400K is rich? I don't know about that. You live in New York City, Miami, LA. You make 400K, you're doing great. Don't get me wrong, but you're not like super rich. You're doing good. Two earning family. Let's say each spouse makes 200K. Like, you're doing good. Your kids are good. I'm not saying you're struggling, but you're not super wealthy, right? Let's be honest. So should that number be 650, 2 million, a million? I don't know, but the Biden administration has this fixation with 400K. That's their number. So again, it's going to be hard to show, and it's going to be difficult. They kind of put themselves into a tough corner by saying, yeah, we're not going to have extra audit activity for those under the 400K, when there are partnerships and corporations that have less than 400K that may be the biggest culprits, that may be the biggest tax cheats. But because they're under the 400K, you're not going to go after them at a higher degree. It's like, it's stupid, right? Now, high net worth individuals. The IRS has not had sufficient resources to adequately increase enforcement and close the tax gap attributable to high income and high wealth taxpayers. Taxpayers earning $1 million or more were subject to an audit rate of 0.7% in 2019, sharp decline from 7.2% in 2011. So yeah, these are the numbers. The IRS has less people. They're not able to target folks. We've had a 7% increase in population in the last 13 years. And you couple that with a 20% reduction in full-time employees, you get that 7.2 to 0.7%. I get it, right? Especially if you're the IRS, if you're Department of Treasury, that you count on tax revenue. You're looking at this and saying, hey, all we need is a bigger budget. We just hire more people. We'll audit more people. We'll scare them. They'll pay more taxes, and they'll pay more penalties and interest, and we'll get more people to comply. Again, the issue is, how do you be fair? Right? As I mentioned, I was a tax lawyer for 9 years. You give me any tax return, I'll find something. Whether it's worth my time, whether it's $1,000 of deficiency or $10 million deficiency, you'll always find something wrong with a tax return, right? There's always gray area reporting that happens when you're running even a smaller partnership. Maybe you have a restaurant that generates $800,000 in revenue, right? There's always things that are gray, whether the car was used exclusively for business, whether this travel trip was exclusive for business. Like, it gets gray, and if you're going to spend enough time and resources, like, you're going to find stuff. And that's what the concern is that, hey, if you start pressuring people and really focusing down on everything, like, yeah, of course you're going to find stuff. Now, they use this $400,000 limit to be like, don't worry, you make less than 400K, your audit risk won't increase, and that's great. But again, there's still people that potentially earn less than 400K that may be the biggest culprits. Maybe they are the biggest tax cheats, that they're getting an easier pass versus larger corps and partnerships that haven't done anything wrong, that are going to have to spend more money to advocate for themselves and defend their positions against IRS attack just because they are bigger. It's the way it is. I get it. I understand the IRS needs more people, more money. I think personally they should be spending more, as I mentioned, on customer service, technology, and personnel. Right, the four things this report mentioned. I didn't mention personnel before, but I kind of grouped that into enforcement. But it's customer service, enforcement, technology, and personnel. I say it's three because personnel is really half of it's going to enforcement. and pretty much the rest of customer service. Technology is crap. Let's be honest. The IRS website is great. They haven't their numbers aren't updated. It takes them forever to update forms. It's impossible to get through the IRS. Even if you do, no one gives you an answer. They're sending letters 3 years late. I get it. I get why they need more money. I'd rather them put the money in technology and customer service than enforcement. But hey, if I ran the IRS and I looked at the budget, I would totally get it. So here's some numbers. But out of the 80 billion, 47.4 billion is going to enforcement. That's the idea. But 12 billion is going to technology, 8 billion to retain employees, 4 billion for energy security, whatever that means. 3 billion to resolve taxpayers' issues when they arise. That's good. And customer service, about 4 billion. So if you look at 47 billion to enforcement out of the 80, so more than 50%, closer to 60, and then 12 billion to technology. Okay, so that's where most of the money's going. To break it down even further, about 45 billion enforcement, 25 billion operation support, 4.7 billion business systems modernization. Direct e-file only $15,000. Wow. Energy security 500K just for 2022. So we'll see. I mean, again, I don't know how quick they're going to be able to hire employees. It's awfully hard to find smart people. I don't know what the IRS is willing to pay people, but I can tell you, if you want people that are qualified to audit large partnerships and corporations, you're going to have to pay them better than private practice, because they're not going to go work for the government unless they're paid adequately. And obviously the benefits are good, but the pay needs to be good as well. And I think they're going to have a tough time just training people off the street. So from IRA and 401k perspective, you're not going to see any increase. They're focused on, as they said, large corps, large partnerships, high net worths. If you're a high net worth, could your IRA be audited more frequently? Maybe, but again, I've gone through audits. Like, they don't even look at the IRA. It's not an issue, especially if you're under 72, 73 now. There's no money for them to make. What are they going to do? What did your IRA invest in? Real estate. Okay, who's show me the deal. Here's the deal. Who we rented out to? John Doe. Okay, like, give us the bank statements. Like, there's nothing to find, right? And again, from a public policy standpoint, the IRS doesn't like, no matter what you think of them, they don't like blowing up people's retirement accounts. They will if they see something prohibited and egregious, but that's not what they're focused on. They're focused on large businesses, large corps, large partnerships, and high net worth, 400K plus, generally over $1 million. So for the regular self-directed IRA investors, everyone like me and you that just trying to get by, working hard, making a living, trying to invest and trying to save for their families, like, I don't think we're going to be having to encounter, IRS agents with guns drawn at our doorstep, trying to invade our home and ask us questions like that. Maybe if we were, a political journalist, maybe, but definitely not just regular folks trying to, make a living and do what's right for their family. So all in all, again, they were a month late in this report. It's a lengthy report. You can go to irs.gov and read it for yourself. But I kind of highlighted all the key areas. It's called Internal Revenue Service Inflation Reduction Act Strategic Operating Plan, 2023 to 2031. It's irs.gov/pubs/irs.pdf P3744. I'll put it in the link as well. But ultimately, I think you'll get what you need from this podcast. Everything you'll need to know. There's a lot of just mumbo jumbo in there that is kind of meaningless. So again, from the enforcement standpoint, which is the main part of the podcast, large corps, large partnerships, over 5 million, high net worths over 1 million. If you make less than 400K, personal or business, the IRS promises us we're not going to see an increased level of audit, but who knows? But specifically to self-directed IRAs and solos, good news. There's the word retirement or pension plan. It's not anywhere in this document the word IRA is, but only because the name is Inflation Reduction Act, not because it's self-directed IRAs. Cryptocurrency is another area that they have some chatter on, but again, talking about owning cryptos personally, not in a retirement account where it's not a taxable event. So ultimately, this is good news from a self-directed retirement standpoint. It's not really a focus at all on the enforcement budget, but we'll see. To be continued. Again, I don't think we'll see any movement for 3 to 5 years because it's going to take them years. They want to hire 7,500 people in the next year. They're going to have to train them. So I don't think it's, at least till 2025, we're not going to see any material, enforcement increases, and then we'll see what happens by then. There's always a chance they lose some of this budget, but to be continued. So hope you guys enjoyed today's podcast. It's always interesting. love going through and learning and reading how governments talk about spending their money, our money, I should say, our tax money. They're spending our tax money against us, but I get it, right? The IRS needs to do their job. I get it. We just want to make sure they do it reasonably, fairly, equitably, and their equitable standard is if you make more money and you're bigger, you're going to have a bigger audit risk. And maybe they're right. There's more money there, and that's probably right since larger corps, larger partnerships have more resources to defend themselves against maybe unwieldy IRS attack, whereas you and me don't, right? We can't spend $100,000 to defend ourselves if we have a crazy IRS agent that's trying to basically cancel what we think is a reasonable deduction. So and just the highest enforcement actions are actually on low income taxpayers. They get an earned income credit, which you need to make like under, I think it's married filed jointly, it's like 60 or 70K. That's the highest audit rate, is people that they claim are abusing their earned income credit. So the fact is they're going after the smallest, the lowest income folks now, and they're generating the most revenue. Why? Because those folks don't have the ability to defend themselves. They get a letter, they get scared, and they pay. Where someone who's most sophisticated may say, you know what, I'm going to send this to my accountant. I'm going to fight it. I don't think I'm wrong. But there's a level on how far we're going to take it, right? We may not go to tax court, but maybe we'll enter in a letter writing campaign to defend our position. Whereas a large corporation, a large partnership, high net worth, maybe probably will allocate more resources to defend their position, and that's the IRS's position. It's like, hey, we'll get more money. You have higher capacity to pay and defend yourself, so we think that's more equitable. Well, could be true. We just want to make sure that, in fact, they're not overstepping their responsibilities and their duties under the Constitution, and they're not harassing folks. That's what we're all concerned about. So I promise I'll do my best to keep everyone in the loop of anything I hear. But the good news is self-directed IRAs and 401k seem to be safe and are not part of any enforcement type of focus from the IRS based on this budget report. So thanks again for spending some time with me today. Really appreciate it. Hope you guys enjoy the podcast. Have an amazing rest of your day, and I'll see everyone again next week. Take care.